Hi everyone, this is Robert J. Bailey, CPA. If you're a homeowner in a high tax state, 2025 just gave you a very big change, and it's finally good news. The SALT deduction, which has been limited to just $10,000 since 2018, has now been increased to $40,000 under the new tax law. Now, this is one of the biggest parts of the entire tax bill, but here's the problem. Many people have no idea whether this helps them or not. So in this video, I'm going to break this down clearly and simply by explaining what the new SALT cap actually means, who benefits and who gets absolutely no benefit at all, and whether you should take the standard deduction or itemize. All right, so let's go. What exactly is SALT and what changed? Well, SALT stands for state and local taxes. It includes your state income taxes or state sales tax if you choose that instead. It includes the property taxes on your home, city or local income taxes, personal property taxes on your vehicles. Under the old rule, the one you've been stuck with since 2018, the maximum you could deduct for those items was $10,000 total, period. Now in high tax states, that barely scratches the surface. Beginning in 2025, the new tax law raises the SALT deduction cap to $40,000 for tax years 2025 through 2029. So instead of being limited to $10,000, many people can now deduct $20,000, $30,000, or even up to $40,000 of combined state income taxes and property taxes. This is a major change. Now, who benefits the most? The taxpayers who benefit the most are homeowners in high tax states, especially California, New York, New Jersey, Connecticut, Massachusetts, Maryland, and Illinois. Married couples also with both spouses earning as their combined state income taxes and property taxes can easily exceed $40,000. And also taxpayers who were previously itemizing back in 2017, many of you will now be returning to itemizing. Also, retirees with high property taxes but moderate income. Now, who gets little or no benefit? Now, this is important. The SALT increase does not help everyone. If your state taxes plus property taxes are below the standard deduction, you won't itemize anyway. So if you live in a no-income tax state like Florida, Texas, Nevada, Tennessee, Wyoming, South Dakota, and Alaska, then the SALT cap increase often won't matter unless you pay very high property taxes. Now, how does SALT interact with the standard deduction? This is where confusion sets in, so let me make it simple. In 2025, the standard deduction increases significantly. For single, it's $15,750. For married filing jointly, it's $31,500. So here's the question. Will your itemized deductions be more than your standard deduction? So let me give you an example. So say a married couple has state income taxes taken out of their paychecks of $14,000. They pay property taxes on their home of $12,000. They have mortgage interest of $9,000, and charity they give $4,000. So their total itemized expenses or deductions are $39,000. Well, obviously their standard deduction is $31,500. So since $39,000 is higher, you're going to itemize. Okay? And this is what the SALT cap being $40,000 instead of $10,000, this is what makes it possible. So for a real life example, how big is the benefit? Well, in the example I just gave you, because of the increase in the SALT cap, you would itemize your deductions. And if you were at a 22% tax rate, you would have $1,540 in lower federal taxes this year by itemizing instead of taking the standard deduction. Now, big question. Are there phase outs or income limits? Now, this is one of the beautiful things about this provision. There are no phase outs for the $40,000 SALT cap. Unlike, for example, the tips and overtime deduction, this one is not income limited. Now, how to claim the SALT on the 2025 tax return? This is a very easy part. You simply have to itemize your deductions on Schedule A. So on Schedule A, you're going to list your state income taxes withheld from your pay. You're going to list your property taxes paid on real estate taxes paid on your home, and your mortgage interest, your charitable contributions. All right. So then your total itemized deductions will flow to Form 1040 itemized deductions, and that will replace your standard deduction. So again, as long as your itemized deductions are higher, you win, and you'll get even a lower federal income tax liability and hopefully a bigger refund. So here's the big takeaway. If your state taxes plus property taxes plus mortgage interest plus charity add up to more than your standard deduction, you may save thousands of dollars by itemizing in 2025. Millions of taxpayers who've been taking the standard deduction since 2018 may now be switching back. This is one of the biggest homeowner tax benefits in nearly 10 years. If you pay state income tax and property tax, please don't ignore this one. Run the numbers or talk to a tax professional because you may be entitled to a very large deduction starting in 2025. Now, if you found this video helpful, please like the video and subscribe. My name is Robert J. Bailey, CPA, and as always, my mission is to keep more money in your pocket where it belongs. Thanks so much for joining me, and I'll see you soon.